Compared to startups, they've already have brand recognition and a massive client base. Compared to financial incumbents, they have a strong customer orientation and they know how to provide a great user experience. They also have access to potentially wider sources of data. Using big data, big techs can provide artificial intelligence-based financial services, for example, to assess the creditworthiness of their customers. Big tech's promise is to make payments and financial services as easy and as cheap as sending a text or a picture. This could potentially change and reshape the financial sector's landscape for the future. However, as they grow and become a systemic part of the financial system, things become a bit more complex than sending a text or a picture. Finance, after all, is the most regulated industry in the world, and for good reason. It's about money, and it's systemically important. The opportunities seem plentiful, but there are quite a few concerns. Unlike banks and financial institutions, big techs know who our friends are. They know where we go. They know what we buy, and they know many more of our more personal traits. So what does it mean if they now have access to all our financial data as well? Should we be concerned about issues like privacy, market concentration, the impact on competition? If big techs compete with banks for our money, should they be regulated like banks with the same capital and liquidity requirements? Should they be covered by deposit insurance? Should they have access to central bank liquidity? Given their global reach and size, it's natural to consider their contribution to systemic risk and also the international ramifications of services they may provide that will ignore national borders the same way that an email does. Consider the new private digital currencies being offered by big techs and whether they could displace sovereign-issued monies in some jurisdictions, and the impact that that might have on the international monetary system. Clearly, as big techs scale up, regulation needs to keep pace so that we can embrace the benefits offered by new actors while also dealing with the risks. At the IMF, we're trying to understand the implications of all of these developments for all of our members. We see the IMF as a point of convergence, a place to exchange experiences and points of view on this subject. At last year's annual meetings in Bali, Indonesia, the IMF and the World Bank together launched what we called the Bali Fintech Agenda. We identified 12 priorities that countries and other international organizations should focus on when thinking through the challenges of fintech. This Bali agenda called for a balanced approach between allowing innovation to happen on the one hand, while ensuring market and financial integrity, consumer protection, and financial stability at the same time. That balance is critical to deliver the potential benefits of technological innovation, including from big tech, while also mitigating the risks. Well, let me stop with those remarks. We have a great panel of experts. I hope you all will enjoy this session. So over to you, Elizabeth.
As David mentioned, we have a lot of ground to cover today, so I'm going to quickly introduce the panelists and then get right into it. To my left, we have Jason Furman, professor of the practice of economic policy at Harvard Kennedy School, also former top economic advisor under President Obama. Mark Carney, governor of the Bank of England. David Marcus, head of Calibra, also former head of messaging services at Facebook, also former president of PayPal, relevant to the discussion today. And Nandan Nilekani, co-founder and chairman of Infosys Technologies. David, I'm going to kick it off with you because there's no doubt that Facebook's entrance into finance over the past few months has elevated this conversation, the announcement of Libra and the Calibra digital wallet. Talk about exactly why and the advantages of big tech bringing to the financial scene. Set the stage for us here.
So I think it's important to talk about the problems that so many people are faced with today within the current constraints of the existing system. 1.7 billion people still don't have access to digital money. Sending money across borders still costs on average 7%. Even domestic payments are not really efficient and cost a lot of money. And I like to make the parallel of what happened to the telecom industry in terms of services that benefited people pre and post-internet. And pre-internet, we were in a world where we used to pay up to $1 a minute for an international call and 15 or 20 cents per text message. And suddenly, with the internet, we can now communicate for free with a $30 Android device. And when you think about money, it hasn't really evolved the same way, and the same person with a $30 Android device doesn't have access to digital money at all. If anything, the poorer you are, the more you're paying for financial services. And as a result, we believe that we can help advance the conversation, at the very least, on what can we collectively do to improve this situation, to improve this system, which at its core, if you look at systems like SWIFT or ACH in the US, et cetera, haven't evolved in the last 50 years.
So Nandan, you led the effort to create a public biometric identity system in India, which did set the stage for this whole new payments infrastructure. So talk about that existing system that's in place and some of the challenges along the way.
Sure. India has had a program for the last decade to put global public infrastructure in the digital way. And I led the effort in the government to give everybody a unique digital ID. And today, 1.2 billion people in India have a digital ID. And that is the foundation for eKYC, or electronic KYC, so that you can open a bank account in 2 minutes, fully compliant with the anti-money laundering and terrorism counter-financing laws, so the AML, CFT stuff. So we work to build this identity system. It's a photo ID which is online, so I can go to any location, do a biometric authentication, and open a bank account. So using this, the government launched a program in 2014 called Jan Dhan Yojana, with which they opened 330 million new bank accounts. It's the world's largest financial inclusion program, and according to studies done by the BIS, India did in 10 years what would normally have taken 46 years. So the first piece of this puzzle was the eKYC, which is essential to financial inclusion, because if people don't have an identity, they can't open a bank account or get access to financial services. The second part of this is the development of a payment system called Unified Payment Interface, which is a completely interoperable peer-to-peer real-time payment system, instant payments. And this was designed by the central bank and the banks themselves. But the uniqueness of this model is that big tech participates along with the banks. And therefore, it's a model where under the aegis of the central bank and banks, big tech participates. So today in India, last month, this platform did about 955 million transactions worth about $23 billion. And there were 6 players competing. There was WhatsApp Pay, which is a Facebook product, Google Pay, Amazon Pay, Phone Pay, which belongs to Walmart, Paytm, which is funded by SoftBank. So it's a very, very thriving thing. And this has shown that you can have an architecture where you get all the benefits that we talk about. We get convenience, we get instant payments, we get them cheap, we have instant provisioning, and you can do it within the system. So this is a way of doing it without necessarily disrupting the whole thing. And this has been very, very successful. And in fact, WhatsApp has launched it on a pilot basis with 1 million users. And they made it as simple as sending a message. I mean, it's a brilliant implementation. And they're now in negotiations to let all the WhatsApp users in India use this platform, and there are 400 million of them. So I think what India has shown is that all the benefits that we're talking about, convenience, ease of use, low cost, and financial inclusion, can be done in the existing system very well.
So I want to talk a bit about that interplay between the tech companies and banks. And I'm going to ask you, Jason, do the banks have more to gain by collaborating with tech companies, or should they be trying to compete in this environment?
I would almost ask a business strategist that before I'd ask me that. Right now you're seeing a lot of collaboration. You have two industries, both of which are very concentrated, and then when they come together, does that count as more competition, or when they come together in a collaborative way, is that an even greater degree of concentration across a wider sphere of places? So I think they, at this stage, have a lot to collaborate. But then you look at Libra. It's not like the major banks have chosen to collaborate in that project and join in it. So you're seeing some places of collaboration, some places of competition, and I think what's most important is from a public policy perspective, we need to decide whether that collaboration is a good thing or not, whether it's interfering with competition or promoting competition, as opposed to just what's in the interest of these two highly concentrated industries.
So Governor Carney, the question to you then, from a public policy perspective, do tech companies need to abide by the same rules that banks abide by, or should there be an entirely new set of rules here?
Unlike the question you asked, Jason, that's simple. The answer is yes. Same risks, same rules. And one of the important things when we get into payments, for example, is, and what we're realizing as regulators is that we need to look at the ecosystem as a whole. So not just a narrowly defined slice of the payment system, because it is, in many respects, all interconnected. And if there is a new form of payments architecture that develops that could be systemic, then it's not just certain elements of it can fall under specific regulatory approaches which are not best suited for regulation of the entire system. And can I take a step back, though, and just sort of give an overall approach that we've tried to take to these sets of issues. The first thing is our job is to ensure monetary and financial stability, okay? Subject to that, though, what we want to do is enable innovation and empower competition. And so a common theme between what Nandan and his colleagues did, which is remarkable in India, and Jason's work, some of his work for the UK government on competition, has been how do you set up platforms that are open source, that lean against the natural network externalities and lock-in effects that we get in tech as a whole, and that can enable competition, and it could be competition amongst wallet providers in the payments landscape. It could be competition, and one of the things, and I'll stop with this, that we're going to do in the UK, I think the government will pursue, which is to set up an architecture for SME financing, so that, and borrowing in many respects an idea from India, so that the SME owns its data, not just its financial data, asset data, but its sociograph, its search data, and it can port that data file through a data trust or data fiduciary, again, ideas that have been put in place in India and developed by Jason, and go from a bank to a fintech startup to a big tech to a platform in order to get competitive financing. And in a country where there's a £22 billion SME funding gap, that's a way you can work with the advantages of big tech, but create an architecture that has competition.
And do you see a payment system like Libra fitting into that architecture?
Okay, so that's a clever segue. It's what we see is that the issues that David started with and the issues that have been are being addressed in India absolutely apply to countries like the UK. It is still too expensive for people to send payments cross-border, and particularly the poorest or the least well-off members of our society to send payments cross-border. And it's too expensive and too slow to send domestic payments. There is a veneer of efficiency and accessibility that is in the UK payment system. It is highly efficient. It seems highly efficient to the user, but it's actually quite costly. And there are different approaches to improve that system. Now, but those approaches have to meet all the standards that not just the banking system, the banking system has to, but standards of data privacy, and anti-money laundering, counterterrorism financing, which of course Libra, if it comes to pass, would have to, and as well, last point, has to be enacted in a way that is pro-competitive, not anti-competitive, and so there are a very wide range of issues that need to be addressed in a way to solve the issues that, again, the India stack in many respects advances to solving.
The other country, not just India, that's done this in a completely innovative way and has leapfrogged much of the world in payments, at least, is China, of course, and that's been with the help of Alibaba with Alipay and Tencent with WeChat Pay. So, and we've seen how, with those payment methods, banks do not have the same traditional role. So Nandan, as that Chinese model spreads, what will the role of banks be, and how popular will those services continue?
Well, I think one thing we should realize in payments is that payments vary dramatically by region. So the US was really the inventor of digital payments using cards. So it's a heavily carded market where people use cards and pay through POS machines and so on. And later on, that technology went online. Africa has seen what's called mobile money, where telecom companies provide money like M-Pesa. China, as you have said, has been an amazing success story, but it's a duopoly. So if you look at digital payments in China, it's WeChat and Alipay, which is great for them, but we don't know what's the overall impact on the economy. Why I think the India model is important is that it's an open access model. It allows any big tech to participate. So WhatsApp can participate, Google can participate, Amazon can participate, but they have to come through the banks. And it is interoperable, which means that I can have WhatsApp Pay on my phone, and I can send money to you, and you may be using Google Pay, and it doesn't matter. And I think the heart of payments is interoperability. And I think that's the whole thing, that even messaging, which is a great success story of Facebook, finally you have to have the same product on both the sides to talk, whereas an email I can send to you without worrying where your email is. So I think payment is so fundamental to an economy that you need an interoperable payment system, which is very, very critical. And therefore, I think they have to give us an answer on how it's going to be fully interoperable. The other point is cross-border. I'll just spend a minute. Cross-border remittance is a huge challenge. Today, the world has $689 billion of cross-border remittance from 230 million migrants. And there are a few countries where it emanates from, like the US, and there are a few countries that receive the money, like Mexico, China, Philippines, and India. India is the largest with 72 billion. Philippines, a small country, does 34 billion. Just the money traffic from US to Mexico is $30 billion a year. Now, this is an area where I think we haven't paid enough attention, and David talked about the fact that the transaction costs are very high. But this can also be solved by bilateral deals between two central banks, which form the corridor to connect the real-time payment system of both. So I think that's how if you take the top 10 corridors, that's 80% of the flow. So I think there are ways to do this within the system, which is what I would recommend.
David, maybe you want to respond to that.
Yes, well, look, I really care deeply about interoperability. It's the current state of things is such that in countries like the US or the UK, if you use one wallet provider, you can only send money to the same wallet provider, and that's within one country. I think India has to be commended for the work it has done with digital identity and UPI. The problem is those efforts are often domestic in one region. And there's no such system as the internet for money. There's no way to move value around the world the same way that you can send an email or a text message. And we believe that an open yet regulated system, and we've said this from the beginning, and this is why we've announced Libra well before even starting any implementation plans, because we agree that this has to meet the highest regulatory standards and address all concerns before moving forward. But at the core of it, how can you have an open, competitive system that enables moving value around the money for a very, very low cost, and that is open to anyone with a $30 smartphone? That's the goal and mission of Libra, and that's why we're so passionate about it. It's all about people and delivering value for them.
How important are banks in that goal? Because we talked about how there so far have not been any banks as part of this effort. don't you need them to make that kind of bigger goal?
Absolutely. We absolutely need banks, and I believe that banks will ultimately join. I think it's harder for very large regulated entities to take an active part in this fight right now, given the climate and the pressure. I think that once we've done a really good job as the Libra Association to address these concerns, and I want to remind everyone here that the Libra Association is now officially 48 hours old. So it was formed 2 days ago in Geneva. We now have a governance and 21 members. But it will take time for us to address all of the regulatory concerns that were raised, and it's our duty and our responsibility to come with answers to all of these questions collaboratively. And I think once we've done this, then I think you'll see more banks and more traditional financial services players join the effort.
And I just have to follow up on that because you've made a point that it's no longer Facebook's project entirely.
Correct.
This is the Libra Association's project. How do you convince companies now that that's the case, especially given the ones that have recently dropped out?
Well, we have at the Libra Association about, I think, 1,600 organizations around the world that have expressed an interest in becoming members. Out of these, I think about 180 meet the high bar, the criteria that was set by the association to become a member. And now it's in the hands of the Libra Association to run a process to welcome more members, but there's no shortage of desire and shared mission to join this effort. So, the goal was always to launch with about 100 members, and I believe we'll have no problem getting there by the time we launch.
Jason, talk about that data mobility concept that we were alluding to before there.
Yeah, so I think the issue of interoperability is important. One, it's a benefit for consumers. It makes it easier to use something when you can interact with anyone. It's also really important for competition. If email, for example, had been invented by one company and only let you email within that one company, people would be running around saying, oh, this is a network, and you wouldn't want to break us up, because if you broke us up, people couldn't communicate with each other, and we need to be at this scale. Email, of course, was invented with open standards, and so you can use any email system and any client, and they can communicate with any other email system and any other client. And so some of the network externalities that you see in the walled gardens, you don't see there. If you're a startup, I don't think anyone should impose interoperability on you. If you want to create your own little walled garden, only have your system stay within yourself, I think that's fine, because I think we want to have room for innovation, for entrance, for trying out new things, and sometimes open standards impose a least common denominator standard and get in the way of innovation. So the way I think you want to square that circle is startups can come in and do anything. If you are, though, already a platform, you already are a bottleneck or a gateway into something, then I think the open standards become quite important for you. A lot of times you recognize that. There's great things that Facebook does on data openness, the data transfer project, and the like. But a lot of times your incentives aren't fully aligned with that. So you look at the banks in the UK, and it took an order from the Competition Authority to set up open banking because it was not fully in their interest to make themselves as interoperable with the fintechs as they otherwise should have been. So I think interoperability is important. I think a lot of times it's going to happen naturally. I don't think you need to impose it on small players because you want innovation and entry. But for the big players, their incentives just aren't fully aligned with it. And so sometimes it will take a policy to impose and require more of that interoperability.
Governor Carney.
Well, can I just extend this line of thought to the central banks themselves? Because, of course, we can be closed in terms of who has access to our balance sheet, who we allow to compete against each other, and that actually can stifle competition itself, competition with the banks, competition across the payments chain. So one of the things that we have done in the last year or so, 18 months, is to open up our RTGS system, which is our high-value payment system, to non-bank payment service providers. So WorldPay would be an example, but they were the first one to be licensed. There's 6 others who have been licensed. There's 20 in the queue. And that and we're also now about to consult on opening up our balance sheet, not from a lending perspective, but actually leaving excess balances with us. Of course, it's the safest place to leave excess balances with the central bank, which is an advantage that the banks have in the system because they're the first concentric circle outside of the central bank. But as the payment landscape changes, and potentially changes quite radically, it's an open question whether that's the right thing to do from a competitive perspective. So it gives, I bring it up just because it gives a sense of how we can empower competition by leveling the playing field across providers and not just always having the providers having to ultimately, in effect, resell central bank services through the banks.
How important are those efforts also in making sure that central banks keep up with the innovation that's coming from these companies?
Yeah, well, I mean, we need to keep up, or we need to enable that innovation in a safe way. I mean, we are central banks after all. We're not going to be at the cutting edge of the innovation, and we're not going to be able to exactly predict where the system is going to go. But as much as possible, by leveling the playing field, as I was just saying, we should spur innovation because we remove some impediments, some built-in impediments to that, to competition.
Is there any risk that the central banks could be left behind here?
No. No, I don't think there is. I honestly don't. Because, and that's not hubris, it's the fact is that the financial system ultimately, as David Lipton said at the start, it's the most heavily regulated part of the economy. That is for a reason. There's lots of ways it can go wrong. And there's particularly ways that new innovation that in itself is quite positive. You use the example of Fintech in China, huge advances in Fintech in China, but also helping to spur one of the larger shadow banking bubbles that is present in the global economy today. So quite often a good idea leads to other issues, which is why the central banks and the regulators have to be on top of them, and it's why we have to look at the system as a whole. Again, I'll use the example of India, where some of the solutions around the tech stack, and particularly, as I understand it, the data trust, the data fiduciaries, is overseen by the Reserve Bank of India, which is another attachment point, if you will, to the system. So I don't think we're going to be left behind, and the trick is not to stay up with innovation by stifling innovation. So in other words, it's safe innovation, and you'll see it with the G7 report on stablecoins that will come out this week. You'll see it with a variety of other initiatives. We just released, and I'll finish on this, our principles as the Bank of England for overseeing payment systems as a whole. So
I want to get into the stablecoin discussion, but Nandan, maybe you could build on that India example. What were kind of both the legal and technical blocks that were required in order to enable that payment structure to happen?
Yeah. So the first one I mentioned was giving everyone a digital ID. So we gave 1.2 billion people an ID and built an infrastructure at scale to do that. The system was designed to give 1.5 million people a day an ID, which is why we're able to get the whole 1.2 billion in a few years. The payment system was again designed for this interoperability, and it's highly scalable. But what's also important, which hasn't come out yet, is that digital money is only for people who have devices on which they can store the digital money. In other words, you need to have a smartphone to keep the digital money. Now, in most emerging countries, maybe a third of the population has smartphones, another third has feature phones, and a last third has no phones. And therefore, if you really want an inclusive strategy for digital finance, you need to address all these three groups. So what we did in India is that the payment system, UPI, works both for smartphones and for feature phones. So you don't need a smartphone. And for people who don't have phones, they can use their ID, go to a merchant, do a biometric authentication using a face, eye, or finger, and withdraw money or make a merchant payment. So a lot of attention has been paid to create an architecture which covers 100% of the population. So I think we should recognize that if you really want financial inclusion for the world, you have to think of those who have no bank accounts, those who have no IDs, how to get them IDs, and so on. that's one thing. The second thing I want to mention is that this 10-year journey in India had 3 parts to it. The first part is identity, which I talked about, KYC and all that. The second part is payments. But the third and very exciting part is what we call as data empowerment. And this is the first time in the world that any country has a complete architecture for financial data mobility for every resident and every business. And this is done through an entity called an account aggregator, which is a data access fiduciary, which is a regulated entity that is given a license to operate by the central bank. And the first one just got a license last week. So these guys, on your behalf, get your data from wherever you want and give it to wherever you want. So if I'm a small business, I want a loan, I can get my tax details, my bank statement, my invoices from somewhere else, and send that to a lender, and the lender will then use his machine learning and data to figure out whether this is at scale. That means 1 billion people can use it today and 50 million businesses. So this is the first time anywhere in the world there's a complete architecture for data mobility. So if you think of it, the 10 years is identity, payments, and data empowerment. And I think that's the way to design a system which is democratization, which is open access, which is competitive.
It's an extraordinary example. Can it be exported to other emerging markets or other countries in general?
No, actually there's huge interest. The World Bank has a group called ID4D, which is actually one of the reasons I'm here this week is to meet with countries. I met with one finance minister yesterday. I'm meeting one tomorrow. So they're all looking at how to replicate this model of identity, payments, and data empowerment around the world. But we have the advantage that it's a 10-year journey, and we had a lot of very fine people, technology people, who gave up their jobs in Silicon Valley or wherever to build a national infrastructure.
David, you've talked a lot about those 1.7 billion people in the world who are unbanked, and clearly that's a sector of the population that's been left out by the way the traditional system has worked. So what exactly can big tech companies bring to this picture here to help fill that gap?
Well, so I do want to re-emphasize what was just said, which is it's a three-tier problem. 1 is connectivity, 2 is identity, and 3 is access. What we're really focused on is trying to make it more seamless on number 2 in a collaborative, open way, and really build core tech on number 3. If you look at even the US, and this is really an interesting data point that people don't really realize, but there are about 8 million households in the US that are unbanked. And when you ask them why, is that they prefer to live on the edges of the current financial system because unpredictable costs are actually worse than very high costs of payday lending and check cashing services that sometimes charge up to 10% to just cash a simple check. And I think that a new system that enables anyone with a smartphone to pick a wallet among a competitive set of wallets available on a platform, to have digital money that they can send across the world for nearly free or very low cost, is the way forward for that constituency. We're really focused on the first stage of this on people who have smartphones, and we've seen the prices of smartphones go down. Now you can have a fully featured smartphone for less than $30, and people who can identify themselves, but not necessarily people who are banked. So that will require all the wallets that are going to be built on Libra to build cash-in and cash-out services so that people can exchange cash for Libra and start using the ease of use and ability to send money around the world. So that's what we're focused on, and we believe that Libra can really address that part of the population that is currently left behind.
Jason, when you hear that as a policymaker, what do you hear? Does that raise concerns with you, that kind of goal?
I mean, it's hard to hear that and not be excited about spreading a product to 1.7 million people, about bringing costs down, about connecting people financially in the way that they've been connected in so many other ways. And I think it's important not to lose sight of those enormous benefits we get, in digital platforms in general, and this one too, from issues of scale and scope. So I think we don't ever want to lose sight of the inspiring story David is telling, What we also, though, don't want to make sure we then reproduce in a new sector some of the issues and problems we've had in other sectors. And getting that balance right, where you can have the innovation, have the benefits for people, but make sure it's the type of interoperability we were talking about, mobility so people can move from system to system, some of the data we were talking about and all of that, and think about that intentionally from the outset. When the companies first started, the digital platforms, they were sort of small companies in this wild west, and you could be forgiven for a sort of break things and fix it later type of ethos. We can't do fix it, break things and fix it later ethos when it comes to the global financial system. So I think you want to have both of these thoughts in your head as you approach this sector.
Governor Carney, what are some of those impacts on the global financial system that you're considering?
Well, so if this is successful, or something like it is successful, it becomes systemic. So it is integral to the system. It's integral to people's everyday lives, and it's and is part of the core architect, would be part of the core architecture of the system. So that in and of itself means that it has to be always on, 24/7 operational resilience, the kind of things people would expect. Secondly, there are a series of, I'll put it, financial or treasury-related issues around a stablecoin structure. So how is the stablecoin backed? What I've exchanged my my fiat money for the stablecoin. What's the backing asset? Do I have an underlying claim to that backing asset? So is it backed in concept or is it backed in fact? What happens if the stablecoin, if it's a basket of underlying currencies? What happens if that basket is rebalanced, and what happens to the prospect of it potentially being rebalanced to the stability of the system? How are the revenues generated? I mean, these are all questions that Libra and others are trying to work through or looking to work through, but how do the revenues cover the costs of the system? And then in terms of the actual everyday functioning of the system, how is the KYC questions and all the associated AML, anti-money laundering, counterterrorism financing issues addressed? Do you just know the individual when they enter? Can they be tracked on a wallet-to-wallet if it's exchanged on between wallets by different providers? How do how does that knowledge? On one level, you want that knowledge. Certain authorities want that knowledge. On another level, from a privacy perspective, there are limitations on the provision of that. I mean, there's a host of very large issues that need to be resolved. And then there are issues, and I'll finish with this, which to flip back to the global monetary system, which is success also could bring pressure on other currencies. So we move from a world of dollarization to, this global coinization, if you will, and the ease with which an individual with a smartphone, wherever they are in the 187 countries of the IMF, plus, I guess, of the IMF, the ease with which they can move from their domestic currency to a global currency with a click of a virtual button, does that introduce some instability? These are all issues that need to be thought through. I'll finish. Sorry, I said that was my last point, but this is a finishing point, which is different than a last point, I guess, which I'm going to assert. But I'll finish with, there is an upside, though, from the global system of having a basket currency if it is adopted, in that it would be part of, at least in my view, of rebalancing the system away from the hegemon right now, which is the US dollar, to something that is more balanced, which is what a multipolar world needs.
And you talked about this in a speech earlier this year. I mean, would that be a good thing, a lower dependence on the dollar?
We have a multipolar world, many engines of the global economy. We have, there's a huge asymmetry between the balance of economic activity across the world and the absolute dominance of the US dollar. 50 to 70% on any metric, any meaningful metric, commercial or financial metric, is priced in US dollars, whereas the US is 10 to 15% on underlying real economy metrics. Now, it's very difficult to, it's another network effect, lock-in effect. It's very difficult to rebalance, but the rebalancing could happen online, and apart from, if done properly, adding to stability of the system, it would help us, in our view, by increasing the supply of safe assets. It would be one factor that would increase the equilibrium interest rate globally. It would be one factor that would make it topic of this meeting less likely that the world falls into a global liquidity trap. Now, but it's not going to happen overnight, so it's not going to be the solution to our current challenges.
But has this conversation that we're having now elevated the urgency to think about something like that from the central bank perspective, even if it won't happen, especially if it won't happen overnight?
Well, it's not going to happen. I mean, things like this, yeah, they don't happen overnight. Needs to be thought through. I would say those conversations are just beginning. Yeah.
Let's talk about some of the more specific regulatory concerns. Of course, privacy is a major one when we're talking about banking data and financial information. So, Nandan, to you, how do you make sure that companies, governments protect that personal information and protect privacy, especially bank accounts, IDs?
Well, I think banks are quite cognizant of the privacy issues. Today bank regulations around the world do have a lot of privacy requirements of how those companies can use that data. I think if we have this big tech come bank model, then there has to be clear rules about which of the data is with the big techs, which of the data is with the banks, and that is something which needs to be spelled out. Also, I think you do need a data protection and empowerment law in every country, and today we don't really have those laws. We do have a GDPR in Europe, but there's nothing in the US, and India still has a draft law. So I think we need to create the legal infrastructure. But I think fundamentally we have to look at how do we use data to empower people. So far we have seen as data as something which enables companies to make money or enables governments to do surveillance. Is there a different way of thinking about data? Can data be put in the hands of the users for their own benefit? And that is really the architecture of the future which we need to work on. And that's working today in India.
Jason, what kind of, putting data in the hands of the people, plus the antitrust concerns, how is this interplay working when you think about especially the competition aspect?
Yeah, data is a really important thing for competition authorities to be worried about. It can be a real barrier to entry. It can, when you take your data that you have in one place, maybe from people's social networks, and use that to compete in another space, if it's a banking space, you then mingle the competition concerns we've been talking about, you mingle the privacy concerns, the reliability of data you use to target an advertisement to someone, and you're sort of taking a guess at what they want to buy, is very different from the way you want to think about reliability in the payments and financial space. So, so I think this data issue is a really important one to get one's head around. I think it has a lot to do with, is analogous in many ways to the interoperability issues that we were talking about. If you're taking your data in one space because you're running the platform, and then you let everyone onto the platform, but you didn't really let everyone onto the platform because you had the data from that platform so that you could, place your product much better on that platform than anyone else, then it's sort of a fake form of competition. If you level the playing field a little bit more in terms of that data, either restricting the way you can move it back and forth between your wallet and your social network, or making it available to everyone, not just to yourself if you're moving it back and forth between the two of those, that can foster more meaningful competition and give you more of the benefits and upside that consumers will hopefully get from this whole project, rather than some of the concerns and downsides that we're worried about too.
David.
I do want to address all of these things because I think that we've been, and I speak about the setup of Libra and the way we're thinking about also the separation between Calibra and Facebook. I think we've been quite thoughtful about this, if I say so myself. But look, I don't know whether there are many parallels to a company that starts a project like this, invests in a substantial way for the purpose of innovation, relinquishes control over the network in a way that it will be one among 100 participants in a network in terms of governance, has interoperability built at the core so that any wallet can actually be built and benefit from the distribution we'll offer. Have data portability built in, and on top of things, limit ourselves in terms of the things that we can or cannot do. So, for instance, Calibra is a subsidiary of Facebook, which will keep the data completely separate for Facebook, and so Facebook won't even have access to that data to do any of the ad targeting or any of those things. I do want to stress that the current setup right now is not great when it comes to privacy of financial data. In the US, you can go and buy in bulk credit card data from existing issuers. And so without consumers actually ever being notified that this is happening. So I think there's an opportunity here on a number of fronts. There's an opportunity in doing better on privacy. There's an opportunity in lowering costs. There's an opportunity in lowering barriers of access. And there's an opportunity in improving the efficacy of anti-money laundering and counterterrorism funding by using new technology and by leveraging the openness of a distributed ledger to have more efficacy than a system that solely relies on licensed entities self-reporting things that they discover on their own network. So I think there's an opportunity and certainly a willingness from all the participants in this Libra association to take the time to get this right and to really ensure that there's an improvement on a number of fronts, but not only on consumer benefits, also on the efficacy of meeting regulation and other aspects.
Facebook CEO Mark Zuckerberg is testifying on this topic here in DC next week. So how much of these conversations are you having with him, and how do you kind of distinguish that relationship then going forward?
Well, this hearing was actually scheduled prior to the association being formalized. So I do think that's a real question because, again, since 48 hours ago, we cannot speak on behalf of the Libra Association anymore. And I think that it would be actually a dangerous path for us to continue doing so because then it's going to frustrate all of the other members of this association that are willing participants and that also want to inject their voices. So what's really important as a next step for the Libra Association is also to build its team and have a leader for this association and to have a fully formed staff that can actually go address these concerns on behalf of all the members rather than us continuing to carry that flag.
So this bit of the conversation goes to one of the fundamental questions, which is around where do we draw the boundary between the public and the private? So what is necessary public infrastructure that then allows private innovation and service and addresses some of the issues that were highlighted up front. And one area which creates a boundary is an approach which gives individuals and companies control of their data and all of their data. So an ability to pull in all of their data and then use that to their advantage, to shop their data around and to be forgotten by the company, to be forgotten in one sense, in the company with which they amass that data. Maybe they were on a platform as an individual or a company for a year or so, lots of activity, they are able to take all of that activity and port it to another platform or another provider. The company that ran that platform hasn't forgot one aspect of it, which is the marginal contribution to the machine learning and the understanding of their algorithm, if you will, their credit algorithm, which is just it's an analogy to the credit loan officer who made a lot of loans over time and gradually developed an expertise in making those loans. But the individual can move it around. The ability to do that, the architecture to do that, and the trust around that, to me, feels like, first off, you need legislation to enforce that, but then the architecture that houses that data, it's pretty close, if not in the public sector, in order to have the trust, or it has to be heavily, heavily overseen by the public sector to have the trust. And then the one other point I wanted to make in terms of the boundary between private and public is, as you move from payments towards money, money's public, right? And getting that boundary right and defining who controls the money, where's the trust, where's the underlying money, and the money creation, the ultimate money creation, the backing of the money, I think ultimately for successful payment systems, the end state has to be public money. And I would say that as a central bank, of course, but because these systems will, in the end, rely on degrees of trust for widespread adoption.
Yeah, I just want to emphasize what you just said about public and private roles. Honestly, if there was such a network like this that existed today and that was run by the public sector, then I'd be focused on building the best wallet in the world, and my life would be a lot simpler, and I wouldn't even bother. I think that the real reason we're trying to build this is because it doesn't exist. But I do think that it's important that money creation remains in the hands of governments, and the way we've designed Libra actually prevents it from doing any money creation because it is actually backed one for one with a reserve, with the desire to prevent the association to even deviate from that by having a strict licensing regime. I do think that if we get into a world where we actually end up in a public-private partnership to get this done, it'll be better and stronger, and it will carry a lot more trust. There's a lot of private money creation today in the banking sector that happens, and even here in this construct, there's none. So I would say that if you look at commercial money that is being issued by banks and all kinds of private institutions today, even that is not contemplated in the construct of this project.
Just to, if I may, just to pick up on that. So, in some respects, this project has put these questions squarely on the table. So why doesn't this exist? And if the boundary is public, why hasn't the public infrastructure been put in place? And the way we think about it is, okay, it puts the question of whether or not at the core a central bank digital currency should be there, first question. And it also puts a question of a horse race, if you will, with other ways to achieve this types of payment architecture, which ultimately doesn't rely on a central bank digital currency at the end, because that's not the case in India, but unifies various payment interfaces, which is why you're devoting an hour of broadcast time and all your time to have these discussions, because it really does get into the heart of how the system can be organized, all for the purpose of improving livelihoods of people, domestically, cross-border, in advanced economies, and in the least developed.
I mean, there's a big issue in this we haven't talked much about, which is whether this is an international currency or a domestic currency. Yeah. I mean, you talked about that, Mark, a little bit in the context of reserves, maybe how you're denominating trade and the like. For most ordinary people, they're buying things denominated in their local currency. The vast majority of what they're doing is domestic purchases, not cross-border. Libra is going to have a fluctuating exchange rate with respect to every domestic currency. It's going to introduce a lot of fluctuations in prices that people face. In some countries where those, that might be a good thing and lead to the Librization instead of dollarization or instead of local currency and give people protection. I think for a lot of people, it will introduce a lot of complication and risk. that might limit its take-up. That might, I don't know whether that's a public policy issue or not, but this scale at which this takes place, whether this is a global project or whether you want to get it right and good in many different countries separately, and then have some ways to have those different national systems interoperate. I'm all for having both of those models and approaches compete. In a way, to date, we've done the different national ones. This is the international one. I might bet on the different national ones succeeding over the international project, but I think that'll be interesting and important, because at the consumer level, it's very different than what Mark was talking about for the system.
Just a few minutes, so I'll give you each a word. I know we'll start with you, Nandan, and if you could tie in kind of the big picture prediction here on which of these systems will ultimately win out, or what will this look like looking into the future?
No, I think we should be grateful to Facebook, David, Libra for bringing payments issues to the fore. I think we do need payments to become more efficient, lower cost, highly scalable, more convenient. We do to make financial inclusion easier, and we do need to make cross-border payments easier. I think nobody's arguing about the goals. I believe that can be done with current systems using conventional approaches without creating a new synthetic currency, in a way that big tech is a player in the tent, but not creating a parallel tent. And I think and this is not vaporware. 1 billion people are using it, so it's real. And I think that's what I would focus on.
Yeah, I mean, for me, really, the closing thought that I wouldn't want anyone in this room to miss is the fact that status quo is not an option. And whether it's Libra or whether it's something else, the world is going to change in a really profound way. We see what's happening in China with their central bank digital currency, which I think is actually misunderstood. I think their goal is not domestic; it's really broad, and it has the objective of rewiring financial networks of a lot of countries with the digital assets that they control. I think you'll see a lot of projects that will have a more disruptive mindset. We're definitely in the mode of being collaborative and wanting to get this right and take the time to get this right. But I think the status quo is an illusion, and it won't last for this long.
I think the concluding thought would just be, I agree with much of what's been said, but I'll just associate myself with what Jason said at the end there. There is a for central banks like the Bank of England, this is an imperative to play a role in substantially improving payments. Horse race between different approaches, of which a central bank digital currency based on this type of architecture domestically could be part. There is a bigger, longer-term issue on synthetic hegemonic.
I think in some areas of regulation, you face a tension between you want things to be safer, more privacy, or something like that, and innovation. I think in this space, if you regulate correctly, that's a pro-innovation step. If you have the type of interoperability, mobility, data openness we've been talking about, that gives you more competition, and more competition is essential to drive innovation forward. So I think in this case, regulation for competition, innovation is what we should be most focused on.
And Governor Carney, I just have to ask you, because what would any discussion be these days without a question about Brexit to you? Is it going to happen this week? Is there going to be a deal? How would that change a plan for a central bank digital currency? Any thoughts there?
We're right out of time. We're right out of time. Yeah.
No comment there.
No, I mean, I'm not in the negotiation. So look, my comment is this, that there are fundamental changes coming in the financial sector. The UK is front and center participating in there. You can expect us to be amongst the advanced economies at the forefront of these innovations.
Thank you all so much for this great discussion today. Pleasure having you all. Thank you all.